Some of the sharpest money managers on the planet just quietly moved billions out of Bitcoin, and they didn't send a press release. Meanwhile, your timeline is on fire with "I sold everything" posts, and one legendary investor just called crypto a useless speculative mechanism on live television. So here's the question nobody wants to answer. Is this the beginning of the real collapse, or the most expensive mistake retail investors will make this decade? Bitcoin just broke below its 200-week moving average. That single line on a chart has only been pierced 4 times in the entire history of this asset. 4 times. And every single time it happened, it meant something. Right now, some of the most respected names in finance, people who called previous crashes, people with billions under management, are publicly announcing they are out. Done. Selling everything. And on the other side of those trades, quietly, are a completely different group of serious, data-driven investors who are buying every single coin those people are dropping. Same price, same chart, opposite conviction. One of these groups is about to be catastrophically wrong, and the losses or the misgains are going to be generational. So the real question isn't whether Bitcoin is dropping. It clearly is. The question is, who actually knows something? By the end of this video, the on-chain data and a pattern hiding inside 2018 are going to give you a real answer. To understand why this sell-off feels different, you need to zoom out and look at 3 forces colliding at exactly the same time. First, the rate environment. The Fed has kept borrowing costs elevated longer than most traders expected, and that pushes institutional money toward yield-bearing assets and away from anything speculative. Second, the dollar is strengthening. A rising DXY index has historically been a headwind for Bitcoin because a stronger dollar tightens global liquidity, and Bitcoin runs on liquidity. Third, there is a broad risk-off rotation happening across markets, from equities to commodities. Now layer on top of that the Clarity Act still sitting unresolved in Washington, leaving custody rules and exchange classifications in legal limbo. Institutions that want exposure but need regulatory certainty are stuck on the sidelines. And through all of this, Bitcoin has slipped below its 200-week moving average, a level that historically only gets breached during capitulation events. 3 independent headwinds, 1 chart. So the real question is, who exactly is hitting the sell button? So let's cut through the noise and look at what the chain is actually telling us. On-chain analytics platforms like Glassnode are flagging a spike in long-term holder distribution. Wallets that have been sitting on Bitcoin for 155 days or more are moving coins to exchanges right now, for the first time since the last cycle peak. That sounds alarming, but here is where you have to slow down and read the data more carefully. When you filter the exchange inflow by cost basis, the picture shifts. The coins flooding into exchanges right now are overwhelmingly clustered in the $60,000 to $70,000 acquisition range. These are not the diamond hand believers who loaded up in 2020 at $10,000 or $15,000. Those wallets are barely moving. What you're watching is the 2024 accumulation cohort hitting their pain threshold and tapping out. On the institutional side, ETF desk flow data tells a similar story. Tactical rotation, not structural exit. Funds are trimming exposure, rebalancing into treasuries, not abandoning crypto as an asset class entirely. So yes, the selling is real, but the bear case rests on something deeper than that, and it is worth taking seriously. Here is the bear case, and it deserves a real hearing. Jeremy Grantham has made this point for years, and he has not wavered. Bitcoin generates no cash flows. No earnings, no dividends, no intrinsic yield. Every dollar of value is anchored entirely in what the next buyer is willing to pay. That makes it a pure sentiment instrument, and sentiment, as history shows, can collapse to zero faster than almost any other asset class. That is not a crazy argument. That is a serious one. Then layer in the macro environment. When the Federal Reserve keeps rates elevated and credit conditions tighten, risk assets do not reprice gently. They reprice violently. Leverage positions unwind, liquidity dries up, and speculative assets absorb the first and deepest cuts. And then there is regulatory overhang. If the Clarity Act stalls in Congress, or if the SEC successfully argues that major tokens are unregistered securities, institutional access could shrink overnight. Exchange delistings, fund redemptions, custody complications. The mechanics of a regulatory squeeze are not hypothetical. They have happened before. So the question worth asking is, are the sellers actually right? But here's where it gets genuinely interesting. Because buried in the bearish noise is a data point that almost never makes the headlines. The loudest, most confident, I sold everything moments in crypto history have one thing in common. They all marked local bottoms. Not the beginning of a terminal collapse. The bottom. In December 2018, Google searches for the phrase Bitcoin dead hit an all-time high. The price was $3,200. In March 2020, every macro commentator on television called it a failed experiment. The price was $4,000. Then post-FTX in November 2022, capitulation was total and public. Crypto Twitter was a graveyard. The price was $15,000. There's a concept called sell-side exhaustion. The logic is almost brutally simple. Once everyone who wants to sell has sold, there are no sellers left to push the price down further. The only direction available is up. And right now, on-chain data is showing realized losses creeping toward those same exhaustion thresholds we saw at each of those prior moments. So the question isn't just who's selling. It's whether there's anyone left to sell after them. Cast your mind back to December 2018. Bitcoin had just collapsed 84% from its all-time high. Goldman Sachs quietly shelved its plans for a crypto trading desk. A Bloomberg headline declared, flatly, that the Bitcoin bubble had burst. The mainstream consensus was not cautious. It was certain. Crypto was finished. And then Andreessen Horowitz announced a $300 million crypto fund. The reaction was immediate. Analysts laughed. Finance Twitter called it the dumbest bet in Silicon Valley history. These were serious people making a seriously embarrassing mistake, or so the story went. 4 years later, that fund had returned multiples on nearly every major position. The point here is not that history rhymes perfectly, because it never does. The point is that the emotional fingerprint of every real cycle bottom looks almost identical. Total ridicule aimed at the bulls, ironclad confidence flowing from the bears. The conviction gap between those two camps gets as wide as it possibly can. So here's the honest question worth sitting with. Does any of this feel familiar right now? But here's what the sellers might be missing. While retail is nervous and headlines are dark, a completely different class of buyer is quietly loading up. Spot Bitcoin ETFs, products that flat out didn't exist in 2018 or 2021, have continued to see net inflows even as price has drifted lower. That's institutional money, pension allocators, family offices, moving through regulated channels at their own pace, indifferent to the daily candles. Then there's minor sell pressure. Post-halving, the block reward is cut in half, which means the structural flow of newly minted Bitcoin hitting exchanges drops significantly. Less force-selling, full stop. On the corporate treasury side, more public companies are quietly following the MicroStrategy blueprint, adding Bitcoin to their balance sheets as a long-term dollar hedge. And perhaps most important, sovereign wealth funds and nation-state actors are now at the table. These are not momentum chasers. They don't panic. They don't check price on their phones at 2 in the morning. They allocate and they hold. So who exactly has the longer time horizon here? And does that change everything? Here is the hard truth for anyone watching this wondering what to actually do. Look back at 2018, 2020, the COVID crash. The people who panic sold were not wrong to be scared. Markets were brutal, but study after study of on-chain behavior shows almost none of them bought back in at lower prices. They kept waiting for confirmation. They wanted it to feel safe first. And that is the trap, because certainty and price recovery arrive at exactly the same moment. By the time buying feels safe, the move has already happened. The real variable that determines outcomes in crypto is not your entry point. It is your position sizing and your time horizon. A smaller position you can actually hold through volatility beats a large position you panic exit every single time. So before you make any move, ask yourself one honest question. Has my thesis changed? Or have my emotions changed? Because those two things require completely different responses. And when you understand which scenario we might actually be in right now, that answer gets a lot clearer. So here is where everything lands. Scenario 1. Sell-side exhaustion on-chain is real. Long-term holders stop distributing, and the 200-week moving average holds the way it has held in every prior cycle without exception. That setup historically opens a multi-month recovery window. Not a straight line up, but a genuine trend shift. Scenario 2. Macro conditions deteriorate further. Rate expectations get repriced again. Regulatory clarity stalls, and Bitcoin loses that structural floor. In that case, the next meaningful support is meaningfully lower, and the recovery timeline extends by months, not weeks. Neither of those is a prediction. Both are calibrated possibilities you need to hold in your head at the same time. The difference between being ready and being blindsided is knowing which signals to watch before the move happens, not after. We are building a weekly on-chain tracker video series to do exactly that. Hit subscribe so you don't miss it.